Welcome, I'm John Charette, and today we're talking line of credits. What they do, what they are, how they help, and the two different kinds. Okay, here's the fancy definition I found online. A line of credit is an arrangement where a lender borrows a maximum loan amount that the borrower, you, can draw upon at any time. Now, what does that mean? Well, it means if a bank gives you a $20,000 line of credit, you only have to use as little or as much with a cap, a maximum of $20,000. So what are the advantages? Well, okay, let's say you have that $20,000 line of credit and you use $1,000. Well, you only pay interest on the amount that you use. On a standard loan, you get a $20,000 loan and you pay interest right away, whether you use that amount or not. So another bonus is that you can and have the option to only pay the interest, nothing against principal. Now, why would you want that? I mean, a situation may come up, COVID, where you're in hard times and you can just float the amount of that line of credit by just paying the interest until you can put more against principal. And lastly, well, the interest rates are usually lower than a normal loan. So that's a bonus. Now, what are the disadvantages? Well, I figured that there's two ones. One, it's generally a variable interest rate. So it's good in the sense that it can go down, but it can also go up. So keep track of your account. I've seen mine fluctuate 3-4% over the years, so it just depends how rates are going. And lastly, it can be bad if you have a $20,000 line of credit sitting there and you want another camera, or you want to go out for dinner and you say, well, I don't really have the money, but I have it in the line of credit. So you just have to watch it, because it's easily accessible and you are borrowing that, so it's a concern. Now that you have an idea of what a line of credit is, you can see that there's two different kinds: a secured line of credit and an unsecured line of credit. Now, you may also know a secured line of credit known as a HELOC, a home equity line of credit. Now, what's special about this type of line of credit is they leverage the value of your home into what you're borrowing. So it means that you can get usually a lower interest rate, but if you don't pay your loan, they take your house. But it's good. It's a good thing to have, and it gets you a really nice low interest rate. Now, an unsecured line of credit is if you just go to the bank and say, hey, I want a line of credit for $10,000, $20,000. They do a credit check. They say, okay, John, yeah, you're cool. You have good credit. We'll give this to you. Similar to a credit card in the sense that they don't really have a repercussion other than putting a negative impact on your credit score if you don't pay. And because they don't have any recourse and there's more risk for the bank, they usually charge a higher interest rate. Now, as an example here, you can take a look at my unsecured line of credit that I have, and it's sitting at 5.83%, okay, versus a home equity line of credit that it's the same rate as my mortgage of 2.2%. So that's the big difference: unsecured, secured, high risk, ones against your house. I think they're amazing. They're great tools to have. I got my first one when I was in my early 20s. It really helped me keep track of my finances when I was young. It helped me when I did get my first home. I was able to pull $20,000 out of that to do renovations, which I then later got back out of my home. Talk to a lender if that's something you're interested in. If you do want a home equity line of credit, generally you have to merge it up with the same time you're doing a refinancing, because then they'll take that refinancing cost out of the mortgage and they'll work it out that way. So check it out. Thank you for watching. If you learned something, please like this video, subscribe if you want to learn more about personal finances, and stay tuned. Thanks.